So let me start. Good afternoon to everybody. Here in Italy is 6 o'clock, is considered to be late afternoon, still afternoon. My name is Nicola Dimitri. Nicola is the first name, Dimitri is the surname. And I'm professor of economics at the University of Siena in Italy, which is one of the oldest worldwide continuously working universities. And I'm also a senior fellow of Exponential Science, the organization which, as I'm mentioning in the first bullet point, actually allow me to deliver this lecture together with Hedera as such an interesting event. I'm very, very pleased to be here today to speak to people from participating to this hackathon. Let me tell you a little bit before I start about myself. I've been working on issues related to blockchain and cryptocurrencies for about 8 years now. I've been collaborating, besides publishing academic papers, I've been collaborating with a number of blockchain companies, getting grants from them and producing academic reports. Here I mentioned 5 of them. I think I forgot VeChain, which is another one I worked with. And the topics that I've been engaged are some of the topics that I've been engaged with are mentioned here: consensus, voting, and others, I would say, all from an economic perspective. I'm a professor of economics and not, of course, a computer scientist. And more recently, I got engaged with, indeed, exponential science on a project which is currently going on concerning automated market makers. And in particular, the project concerns lending market makers. And this is the reason why I was asked to give a talk on automatic market makers, which would be a more general talk, not only lending, but also exchanging or trading cryptocurrencies market makers. Okay, this can be organized whether on the blockchain infrastructure or hashgraph as Hedera infrastructure. Certainly, automated market makers are an important, very important DeFi area which developed over the last few years and which I'm very pleased to present. Broadly speaking, in the first part, I will focus on some fundamental issues of these objects, AMM, automated market makers. And in the second part, I'll mention some of my work, which I've done, which partly already published, some other is work in progress, which I've done on the topic. Okay, so to my knowledge, at least insofar as I am concerned, I got aware that that automated market makers existed through coming across Uniswap. Okay, some of you might have heard, others may not have heard about Uniswap, but Uniswap is certainly one of the leading examples in this field, and in particular, a platform is a leading platform for exchanging crypto assets. Okay, and that appeared in 2018, if I recall correctly. They got initially got a grant from Ethereum to do that, and then they sort of became completely independent and very successful. Uniswap was actually followed by several other platforms insofar as trading exchanges were concerned, trading platform were concerned, and I'm mentioning here just few of them: Curve, Balancer, and Sushi Swap are all platform, blockchain-based platform, in which you can actually trade one crypto asset with another crypto asset or with a legal currency. And so one may wonder, what is the difference between Curve, Balancer, Sushi Swap, Uniswap, etc., etc.? Well, typically the difference is the focus that they have on some particular currencies, or the type of swaps that you are allowed to make. We'll say, for instance, that Balancer is different in a meaningful way from Uniswap, and Curve also is actually different from Uniswap, although the underlying criteria are quite similar. And insofar as lending platform, here we are to the lending phase, which is related to the as I said, to the current project, which is currently going on with Exponential Science. I just mentioned two of them. Aave, I don't know, nobody knows how to pronunciate this name, AAVE, which appeared in 2018, and Compound, to my knowledge, are the two best known specialized platform for money lending. Okay, so let's start discussing automated market maker. So first of all, what is it? Okay, what is an automated market maker? Whether an exchange platform or whether a lending platform, what is it? What are the main sort of features of this automated market makers, and why is it called automated? Okay, so I would say that the main pillar of both types of market makers are the so-called liquidity pools. Okay, so liquidity pools are simply deposits of tokens, of assets, okay, in general. Okay, so deposits of Bitcoins, deposits of Hedera, deposits of Ethereum, whatever you want to consider, that are actually used to implement the operations, the financial operations that are actually going to be implemented. The implementation, we'll see what kind of operations in a few minutes. The implementation is made through smart contracts, so that's why it's automated. Okay, you know, before you enter the contract, before you start the operation, you know what's going to happen, because the smart contract will automatically implement the operation that you have chosen. Now, who is making the deposits? Okay, well, you know, the platform itself can provide its own liquidity, but most of the liquidity is actually provided by, you know, normal users like me and you, who have actually, you know, some money, and they can decide, we can decide to deposit our money in one of these pools. Okay, and why do we want to do that? Because if we do that, we're going to receive in return a payment from the platform. Okay, so you say, I want to deposit 10 Ethereum, so 10 Hedera units in a particular liquidity pool. Well, if you do that, you're going to receive a reward. So that's why you know, people may be interested in depositing their money. Now, the reward that you get from the platform for having deposited liquidity, the reward that you get is coming from the transaction fees that are applied by the platform over the operations, the financial operations that have been implemented, thanks to the and which are using the liquidity, the deposited liquidity. Okay, and the financial operations that we're going to concentrate upon are, you know, in some sense, standard financial operations. However, applied, through automated and smart contracts procedure, which introduce, and we shall see, which will actually contain some similarities with standard banking and standard operational financial intermediaries, but also a lot of differences. Please. Hello? Okay. There is
some noise, guys.
Yes.
Yeah, guys, please close your mic,
Okay.
guys.
Okay.
Khaled, could you please just auto-mute everyone except for Nicola?
Exactly, that's what I'm doing. Yeah, sorry, Dimitri. We can continue.
Yeah, okay. Can I go on? Can I continue?
Yes,
sure.
please do.
Sure.
Please do.
Thank you very much. So I was saying that the reward paid to the depositors comes from the transaction fees charged by the platform to customers whenever they borrow liquidity or whenever they swap two or more assets or tokens. Okay, so that's where that's how the depositor will be paid, and so that's the so to speak the chain of incentives for potential depositors to deposit their money in these liquidity pools. The liquidity pools will be used to swap or to lend money to somebody. Okay, now these liquidity pools are the essential element in both the lending and the swapping. Okay, so that's the cornerstone of both types of automated market makers. Okay, except that the use that we're gonna do is, of course, slightly, well, quite different if you want. Okay, so let's start from the one automated market makers that indeed, again, based on my knowledge, became more widespread across the world earlier than the other type, namely the exchange platforms. As far as I know, where became known earlier than lending platforms. So here again, what is an exchange platform? Automatic market maker where you can exchange platforms. Well, it's basically a collection of liquidity pools. I'm going to enter into some simple details to be more concrete on what these actors, these automated market makers, these exchange platforms are actually, in fact, doing. Now, there are two main differences between the way you swap crypto assets in Uniswap, for instance, this main leading platform, or the way you swap crypto assets in a standard bank or in a standard, counter where you can do your exchange when you go to a foreign country, you change your currency, etc., etc. There are two main differences. The first difference, maybe three, but let's go on. So the first main difference is that the way the price, namely the exchange rate between the two currencies or the two assets, is actually calculated. Here you will see in this particular type of automated market makers, the way the price is calculated is quite different from the way it is calculated in reality. In fact, in reality, the way you pay another currency with you exchange one currency with another currency is typically, at least in major markets, is typically done through so-called order books. What does it mean? It means, and this is also true for exchange nodes, very popular exchange nodes, centralized exchange nodes like Binance or Kraken or Bitfinex and many others that come to mind, where you can trade one currency with the other. What do you do? These are centralized exchange nodes. What do? You say, I want to trade 100 euros with dollars, okay? So you send an order and they ask you at what price you want to exchange. So you send an order which is composed of a quantity and the price, okay? On the other side of the market, there are, demand for euros. You are supplying euros and you are demanding dollars or bitcoins, for instance. So you have supply of dollars or bitcoin on the other side of the market, and until supply and demand match, okay, there will be no exchange. So you have to perhaps wait some time before you trade, before there is a price on both sides of the market which is the same, and so and the quantity is also the same, and so the market is, according to the terminology adopted by economists, the market is cleared. So for this particular centralized type of exchange, you need a third party, okay, mediating between the two sides of the market for trading the desired quantity and for setting up the price. And the price will be the one that would put together demand and supply. So that's how you calculate the price in centralized markets. In centralized markets, you may have to wait some time when you send the order of exchange. You may have to wait some time until on the other side of the market somebody is willing to take your order. Okay, it may be fast, but it may be late at the same time. Now, these things are very different in automated market makers. How the price is calculated, how long you have to wait, are very different. Okay, so let's see what instead is an exchange automated market maker. Let's have in mind again Uniswap. A liquidity pool in Uniswap. Okay, so one liquidity pool in Uniswap is composed of two assets, okay? It could be Bitcoin and Hedera, okay? Two assets that can be swapped with each other in that pool. Okay, so let me do the reasoning in, again, increase a little bit of my precision for those of you who have not been exposed before to this topic, and general at the same time. So suppose you have two assets, two cryptocurrencies, X, capital X and capital Y, and which are representing your liquidity pool. You can exchange units of X with units of Y in that pool. And suppose, that's the other very important ingredient of the story, that currently the size of the liquidity deposited in the pool of, let me use the pointer, which will facilitate our explanation. So these are the two assets, and small x and small y are the size of the liquidity deposited in the pool of those two assets, okay? So this will be, I don't know, 100 units of X, 300 units of Y, or whatever, okay? So it's very important. These are two very important elements of this story, okay? Notice that, for instance, in Balancer, and here we start seeing some of the differences in these exchange platforms. In Balances, pools can be composed by more than two cryptocurrencies, not just two as in Uniswap, but more than 2. Okay, Balancer came slightly later and extended the exchange market makers to pools with more assets. Now, how is the price going to be determined? The price is going to, so what is the price to swap 1 unit of X with units of Y? So with 1 unit of X, how many units of Y do I get? That's the price. That's the exchange rate between the 2 assets. In the pool is determined, in particular in Uniswap, is determined by this function. I'll tell you what that means in a minute. It's X times Y equals to K. If you haven't seen it before, take it as it is for the time being. The next slide, I'm going to explain precisely what that means. But let me just mention before we go on that this is simply an example, a main example, not just an example, a main example of what are called constant trading bond functions, which, okay, so rather than having the product of X and Y to determine the price, we'll see shortly how, you can have, the sum of X and Y, or some other function of X and Y. So these are called constant trading bond functions. It was introduced by Uniswap and then later generalized by the others. So these functions are used to determine the exchange rate between the 2 currencies, between the 2 assets in the pool. The exchange rate is the price of 1 asset in terms of the other. Okay, what does it mean? A constant function like a constant product function adopted by Uniswap. Okay, so we're talking about reality here. We're not talking about, something in the clouds. We talk about very concrete stuff. That's what Uniswap does. Actually, this is the original version, the version 1. They improved, they introduced some modifications that we're now at version 3 insofar as Uniswap is concerned. But the underlying backbone is the same, okay? Is the constant product function. Okay, suppose, so to understand what this function means, suppose you want to exchange an amount delta X of the of asset X against Y, okay? So suppose delta X could be 10 units, 20 units, 1 unit, it doesn't really matter. Delta, okay, different. So you say, I have this 10 Bitcoins, how many Hedera can I get in return from if I, operating in the pool? Well, the amount of asset Y that you can get in return is determined, we call it delta Y, is determined by solving this equation. Namely, if you take the original size of deposited in the pool of asset X, which is small x, and then you add what you want to trade, you want to give 10 Bitcoins to this pool and receive in return units of Y. Then X plus delta X, I'm going to have numerical examples in the next slide, times Y minus delta Y. The delta Y is what you're going to get in return. It should still be equal to K. Okay, so that's what constant product means. The price, namely the exchange rate between the 2 assets, is determined in such a way that after the trade, the product of the deposited liquidity of X and Y is going to be the same one as before the trade. So before the trade, X times Y was equal to a certain constant K. After the trade must also be equal to K. And this is easy to solve because you know what delta x is, and you only have to find delta y, and this is one equation, one unknown. And the delta y that you're going to get in return is given by this expression, which is more convenient to write by taking delta x to the denominator on the left-hand side, because delta y over delta x is nothing but the exchange rate between x and y, namely the price of x in terms of y. So in other words, it's the number of units of y that could be purchased with 1 unit of x when the deposited sides are small x and small y, and when you actually supplying this much additional liquidity to x that you want to trade against y. So basically, let's take this numerical, super simple numerical example just to clarify this formula. Suppose you start from a very balanced, so to speak, automated market makers. You've got 100 units of X and 100 units of Y in your liquidity pool. And then suppose you are coming to the pool saying, I want to swap 10 units of X. How many units of Y are you going to give me? Well, if you do the calculations, basically equation 5 replacing numbers becomes 100 over 110, okay, because 100 is Y, and at the denominator you got 100 plus 10. So eventually you're gonna get 0.91 as a result. So in other words, given the initial y, the initial x, and the delta x, with 1 unit of x, you get in return 0.91 units of y. Okay, you don't get in return exactly 1 unit of y, but slightly less. Okay, 0.91. But now let's see what are the implications of this general formula. One and many other implications can be drawn from the continuation of this example. Suppose now you keep everything as it is in the first example, except that for now, x is equal to 200, while capital Y remains, small y remains equal to 100. If you do the calculations, so now basically you have 200 units of X and 100 units of Y. Sorry? I can't hear. Is it a question or? Hello?
I just mentioned that I don't think it is a question. If there is any question, guys, please raise your hands. Then we can allow you to intervene.
Yeah. Are there any questions now? Please interrupt me. You can interrupt him anytime. Okay, with questions. I mean. Not with random noise, with with questions. Okay, so now you have x equal to 200, y equal to 100, and delta y will be 4.8. In other words, now with 10 units of x, you can only get 0.48, almost a half units of y that you were going to get before. What did it change? What is the intuition behind this variation? The intuition is very, natural, if you want. If you have 200 units of X and 100 units of Y, now X became much more abundant. Okay, you have much more X units than Y units. So Y is scarce, or at least more scarce than before when you had 100 and 100. And this relative scarcity is reflected by the fact that with 1 unit of X, you buy much lower amount of Y, almost a half, 0.91, you go down to 0.48. So basically, this constant product formula reflects the abundancy or the scarcity of the two assets in the pool, informing the price with which units of X trade with units of Y. So the general conclusion is wrapped up in this slide. The price, like in equation 5, the number of Y units that you can get with 1 X unit increases with Y, okay? Decreases with X and decreases with delta X. And if you think about it, it makes a lot of sense as compared with what our everyday intuition will actually make. So basically, this constant product reflects everyday intuition. Now let's start introducing some nuances, okay? Some important observations that characterize constant product, but also other constant functions in this asymmetric market makers. Now, the first point I want to make is the following. Suppose you are interested in this liquidity pool and you want to deposit, just deposit, not trade, just deposit 10 units of X in the pool. Not Y, but only X, okay? So basically, the number of units of X in the pool will become X plus 10. Now you have this additional 10. And call it this X prime. Now, if you go back to your calculations, the price, delta Y over delta X, or exchange rate or trading rate, whatever you want to call it, is becoming Y over X prime plus delta X. You no longer have only X, you have X prime, because the liquidity of X has changed. So you have X plus 10 plus delta X at the denominator, which is of course lower, because the denominator is bigger than before, than Y over delta X plus delta X. So basically, the morale of this very simple observation is that if somebody is adding unilaterally, what do I mean by unilaterally? Only one asset. You add liquidity of just one asset and not both assets, the price will change. The delta Y over delta X will be this ratio, which is lower than the price that you had before depositing the 10 additional units. And this is why, okay, this price variation is not really a desirable, unless it's really needed. Price variations are not so much desirable. Price stability, at least for platforms, is more desirable. So Uniswap, in order to to avoid price volatility due only to additional unilateral deposits, because there could be price changes due to trades we have seen, but if we have price changes also due to additional unilateral deposits, the price will really, become super volatile. So in order to avoid the volatility due to liquidity provision, Uniswap requires that when you want to deposit some liquidity of one asset, you have to deposit liquidity of the other asset as well, in such a way that the final the price after your deposit will be the same than before your deposit. So let's make the example. Suppose initially you have 200x and 100y, okay? Which means, let me anticipate something that we're gonna see in the next or two slides, which means basically that for small changes, for small trades, with 1 unit of X, you get basically half a unit of Y. This is simply the ratio between the two. 100 divided by 200 for small trades becomes, for small delta X, we're gonna see it later in a few minutes, it's gonna become 0.5. It's gonna simply become Y over X. So initially you have Y over X equal to 0.5. The constant product initially is then 200 times 100 times 100, 20,000 is the value, okay. Now suppose you want to deposit liquidity, and in particular you say, I want to deposit 50 units of X in the pool. And then Uniswap would tell you, oh yes, you can do that, but as long as you deposit also 25 units of Y. Because if you do that, the new quantities deposited will become 250 for capital X, 125 for capital Y, and the ratio between 125 and 250 will still be 0.5. So there will be no change in the relative price. But of course, there will be a change in the constant, which is now, after having deposited the liquidity, 250 times 125, 31,250. This is the new constant, okay? So let me wrap up. If you trade one asset with another asset, the K will not change. If you deposit extra liquidity, so the constant will not change, but if you deposit extra liquidity in order to keep the price as constant, you will have to change the product of the two liquidities. So the constant will jump from 20,000 to 31,250. Okay, so whenever there are operations, either trading or liquidity deposits, there will be a variation either in the price or in the constant, referring to the market. Now, these considerations are going to be taken on later on to talk about an important notion, an important concept, which is called impermanent loss of a depositor. But before going there, let me do a little overview to conclude these fundamentals on price determination for swapping one asset with the other. In Uniswap, we're going to see a couple of other examples later on, but without dwelling too long as we did so far. So suppose you want to trade, a small amount, like 0.01 Bitcoin, maybe 0.0001 Bitcoin. So this delta X is almost zero, okay? What happens to the price? Well, if delta X becomes zero, conventionally you use the derivative terms and the capital delta becomes the small d. The delta X becomes negligible, namely zero. This ratio will become this, where the conventionally the left-hand side is now written as dy over dx rather than delta y over delta x, and the the right-hand side is the same, except that delta x doesn't appear anymore because it's negligible, it's zero. So basically, for small trades, this is the price, y over x. That's what I was claiming before. Y over x is the price. Okay, now let's go to two concepts that actually occupied a lot of attention. We basically already mentioned between the lines a lot of attention insofar as automated market makers are concerned. The first concept related to trading in these platforms is called price slippage. We already discussed this basically, but let's go over again to see it, in a kind of canonical way. We have seen that if you start from 100 and 100 and you want to trade 10 units of X, you're going to get in return 9 units of Y. Okay, so you're going to get a little less than what you in numerical terms. So if before the trade, the price was about 1 because you had Y over X, which is for small trades is basically equal to 1 after the trade, that's the claim. The number of Y reduces from 100 to 91 because you subtract 9.1 that you are giving against the 10 units of X. So basically the number of Y units in the pool remains 91, whereas the number of units, X units in the pool becomes 110. So basically the ratio between the Y and the X after the trade is 0.83. So basically the price for small trades went from 1 to 0.83. So the difference, the new price 0.83 minus the original price, which was 1, which in this case is minus 0.17, has an interpretation. It's called price slippage due to the trade. So the price changes by 17% with respect to the original price. And that's an indicator which is, is of concern when it becomes too large. An indicator of price variability due to trading. If a trade really moves a lot the price, then there's going to be too much variability, and that is not really desirable. That's one concern. The second concern, about which there are strategies to try to mitigate, is called impermanent loss. By who? So why is it called? So first of all, the loss refers to the depositor. If we are the depositors, it will concern us, those ones who deposited money in the pools to get a reward in return. Why it is called impermanent, we're gonna see it in a minute. To illustrate, rather than giving a general definition, let's illustrate with a simple example because we can understand everything through simple numbers. Okay, suppose again you have 200 X, 100 Ys, and assume a depositor. Okay, so somebody comes and say, I deposit 20 units of X, 10 units of Y. Okay, Y 20 and 10 to maintain the price equal to 0.5, to maintain the ratio, the new ratio, which now is going to be 220 divided by 110. 110 divided by 220 will be 0.5 as much as 0.5 is 100 divided by 200. But of course, adding up liquidity, the new constant will no longer be 20,000, but 24,200. Okay, all is fine because we saw it before. But what happens now? Now you have 10 units of X over 110 total units of X in the liquidity pool. You have 20 units of Y over 220 total units of Y in the liquidity pool. So you basically have 9% in both assets of the liquidity pool. So basically, if you want to withdraw at some point, which people can always do, of course, if you want to withdraw your money that deposited, you withdraw 9% of X and 9% of Y. If you withdraw at that time, of course, if you wait 10 minutes, everything will be different. But if you withdraw at that point in time, you're gonna get 9% of both assets in the pool. But before you withdraw, okay, suppose a trader comes into play, because that's what happens continuously, okay? You know, in real time, you have lots of trades. I mean, hundreds of trades in real time. A trader wants to buy 10 units of X, so now delta X is minus 10. And how many units of Y will she get in return? Now, since K prime is 24 and 200, because, you know, the total quantity, total liquidity changed in X and Y, but the price will have to be 0.5. So now we have 2020, 110, 24, and 200 is the number. So because K prime is 24 and 200, you will get in return, so you will have to pay 5.24 units of Y to get 10 units of X. So now depositing Y, getting in return X. Now, the new liquidity pool will be characterized now by the number of X reducing from 220 to 210, because you want to buy 10 units, you bought 10 units. And the number of Ys now increases and goes from 110 to 115.24 because you added up 5 and 24 units to get the 10 units of X. The total product of these two numbers is still, of course, 24 and 200, but the ratio has now changed from the original, where it is, sorry, went to the wrong direction. The original was 0.5, okay, the original ratio between X and Y, so the price of Y in terms of X was 0.5, now it's 0.555. You may say, well, what does it change? Well, if you're talking about thousands or millions, it does change a lot, okay? Okay, next point. Because of the arbitrage activity, so this is the price within Uniswap, you know, how much you have to pay to trade one asset with the other, 0.55. Now, because you also have an outside world where all the markets are playing the same game, other automated market makers, centralized exchanges, and the so-called arbitrage activity will take place. What is arbitrage activity? For those of you who haven't been exposed to this notion, but I'm sure many of you know what I'm talking about. is the activity of buy and sell that operators, investors undertake in order to exploit price differences of the same objects across different markets. If the prices are not the same, I can get some advantages by selling in one market and buying in the other market, selling one currency in one market and buying the other currency in the other market, or vice versa. But in doing that, if all investors, being aware of this price differential across different markets, do that, the prices within the automated market makers and outside the automated market makers will tend to equalize. So also the price outside the automated market makers will be about, I wouldn't say exactly, but about, because it takes time, it takes exchange fees, it's not frictionless. The arbitrage activity, it takes energies and resources. So it's hard to have exactly the same prices inside and outside the automatic market makers, but they tend to be the same, okay? So what happens is that now the outside price will also tend to be 0.55, okay, outside the automatic market makers. And if you calculate the 9% deposit, or the current deposit that you made at this price, 0.55, the total value of your deposit, okay, which you have made in the automatic market maker, will be 20,76 cents units of Y. Okay, so just about 20.76 units of Y, calculated at this market, but also within the AMM price. That will be the value of your deposited liquidity. What could have been the alternative? The alternative could have been not to deposit. Okay, so you kept 20 units in your wallets of X rather than depositing it, 10 units in your wallet of Y, and at this price, 0.55, the total equivalent would be 21 units, different from 20 and 76. So basically, the difference between 21 and 2076, which is 0.23, again, if these are Bitcoins, is 20,000 euros or dollars, okay? So it's not peanuts for, average person. This is called the impermanent loss. Okay, so now we can recapitulate. Why is it called impermanent loss? Loss because keeping your liquidity in your wallet and not giving it to the automated market makers, you would have had a higher value, 21 versus 20. So if you deposit, you lose something. Impermanent because it is only at the moment until you effectively withdraw your money from the liquidity pools, you don't make any losses, okay? You make a loss if you decide to withdraw at this price now, and then from impermanent it will become effective. But you can read impermanent as hypothetical loss, if hypothetical in the sense that if you withdraw now, you're going to lose this, okay? That's also important because if these impermanent losses are, big, very frequent, etc., that could discourage potential depositor to deposit. So it is an issue of concern for the AMM, because if we don't mitigate the potential loss of the depositors, we're not going to get deposits, and we're not going to do any business. Okay, there are strategies. You can find them on internet. I'm not going to dwell on this now, on how to mitigate the loss, but this is it. Okay, that's the second point of concern. Price slippage, loss, impermanent loss are the two main points of concern. Due to what? Due to the constant product. Okay, story. Here's its more general situation, how to calculate the price. These are partial derivatives. I'm not going to dwell on this slide for those of you who haven't been exposed to calculus yet. I don't know your age, I don't know your background, so I want to play safe, but just for the sake of completion, this is the general, no matter what the constant function is going to be to calculate the price, could be any function f, this is how you would calculate, okay? Let me take another example. This other automated market maker called Curve. Now, Curve...
Actually, sorry,
please.
Mr. Dimitri. Actually, there are some questions in the chat if you want to check them.
Okay, sorry. Or can I, is it, well, let me see if I can see them, first of all. I don't know if I can see them. How many?
Yeah, we have two questions now. We have two questions now.
Are they urgent, or can they be postponed until the end?
Let's keep it to the end then. Let's keep it
okay.
to the end.
If I have difficulties in reading, could you kindly please read them for me?
Yeah. Yes. Okay. So the first one, let's keep them to the end of the presentation.
Okay. But ask if they are urgent. If they are urgent, we answer now. If they can be postponed, we answer later.
Yeah, I guess they answer it. They will be postponed to the end.
Okay. Let's go on. So another example of a trading platform is Curve, so-called Curve platform, where the constant function is not the product, but the sum. So basically, to establish the price with which units of X trade with units of Y, you do the same story. You say, well, X will be summed, added to delta X, but Y will have to be decreased by delta Y, which is, how many Y units will be given in exchange of delta X units of X. And this has to be equal to X plus Y, the initial constant, which is equal to K. So in other words, just to make a longer story short, the delta Y is equal to the delta X. So basically, if you want to trade 10 units of X, you're going to get 10 units of Y in return. So it's not like the constant product, constant sum, what you give, you get in return of the other asset. Why is this so? Why did they decide to adopt this kind of constant summation curve? The reason is that initially, now they have kind of mixed situation. Initially, they were only trading stable coins, which, as you know, but let me share it with you. Stable coins are those coins like Tether or USDC and many others are those coins that trade one-to-one to a specific currency. It could be a dollar, could be whatever. So they all trade one-to-one. And so that's why if you trade 10 units of Ethereum or whatever, or Tether, you're going to get 10 units of USDC in return, because they all trade one-to-one to the dollar. Okay, so by transitivity, they also trade one-to-one between themselves. So you cannot adopt the constant product, because otherwise nobody will trade with you. You have to adopt the constant sum if you want to specialize on stablecoins. Now to lending. Okay, so now is, what is it, the last half an hour or so. Lending platform, that's the other, if you want, traditional financial operation, which normally is performed by banks, commercial banks, cooperative banks, whatever banks. You go and ask for a loan, for a mortgage, etc. What is the protocol consisting of? You have to produce guarantees. If you don't have guarantees, commercial banks will not give you money. So you have to put up collateral, okay? You have to say, well, I have this many, money in my bank account. I have a house. I have a car. I have this state bonds in my wallet. Okay, all those kind of guarantees that would put the bank or the financial intermediaries providing the loan in a situation that says, well, if it doesn't repay me the loan, I can always, get my money back from the collateral. This is traditional banking, and this is also what happens with automated market makers, where rather than swapping, you can actually borrow money as in a bank. You have to have a collateral for that, but if conceptually is the same thing, practically it's quite different. And we're going to see what is the pillar of lending activities in automated market makers, namely the collateral, and how the collateral is going to be used in order for the lender to be, repaid the money in case of risky borrowers. Okay, so again, let me make a simple example, because the concepts are quite natural, and so it makes no point to complicate too much. So suppose there is a lending platform. It could be Aave, could be Compound, could be others. And we call it capital L. And you are taking a loan of size small x of some currency x. Okay, so the lender is given this loan, small x, of a currency x to a borrower B, and you are the borrower. To obtain such loan, you have to provide a collateral. A collateral could be any currency, in particular crypto, but also legal currencies, fiat currency like dollars, euros, or your own country currencies. You have to provide currencies in a deposit as a guarantee, okay? Here, we are simply imagining that the collateral is just one currency. Let's call it Y. And the collateral is small y, while the currency, again, is capital Y. So basically, the borrower will tell you, yes, I'm going to give you the loan, but you have to give me a collateral. You have to deposit in an account which remains locked to you, the borrower. You cannot take money from that account. Okay, it's open, or at least could be opened by the lender, but it cannot be opened by the borrower. Okay, so the collateral remains there as a guarantee. And how much should be the collateral? Okay, if the loan is X, what should be Y to give a guarantee? Well, let's introduce these two prices. this is the price of dollars just to have uniformity of evaluation, okay? So let's evaluate everything in dollars, but it could be in Bitcoins, or could even be in units of X or units of Y. But just to play how normally people play, let's price everything in dollars. So suppose dollar X is the price of dollars in terms of X at time T, okay? PT dollars Y is the price of dollars in terms of Y at time T, okay? Now, suppose time 0 is when you get the loan, when the loan is given, okay? And then time goes on. What the collateral, which I call it C0, collateral at time 0, in terms of dollars, should be. So what should Y be at time 0 in order to function properly as collateral when the loan is equal to X? Well, it should be equal to a value in dollars. Okay, so this is the dollar value, such that the value in dollars of the collateral at the current price at time 0 of dollars in terms of Y, times the number of Ys. So that's the value in dollars of the collateral Y at time 0 must be larger than the value in dollars of the loan at time 0, okay? So basically, these lending platforms require over-collateralization, okay? So you don't have to put up guarantees which are in value are lower than the loan. You have to put up guarantees in your collateral which overcome the value of the loan. And why they overcome, we're going to see it in a minute, in the next few slides. This is called over-collateralization. So when you see over-collateralization, it means that the value of the collateral must be larger than the value of the loan in a common currency, which in our example is dollars. Now, it is also convenient for what comes next, which I simply mentioned, don't worry about it, to also introduce this indicator, which is the value of the collateral minus the value of the loan, everything in dollars, divided the value of the loan, and interpret this as a degree of over-collateralization, how much, to what degree you over-collateralized with respect to the value of the loan. It's going to be useful later on for a short consideration. Now, in the market, when time goes on, prices will change. Price in dollars of Y and X could change. And if at some point, this ratio, the value of the collateral divided by the value of the loan, is going to be less than a certain number, which is larger than 1 because the denominator tau is smaller than 1. So for instance, it's going to be smaller than, 1.2, 1.1, or 1.3, whatever is tau, okay? Then, here's the crucial step. And there is a whole industry on what I'm going to say going on. Then is part of the smart contract that the lender can actually liquidate the collateral. So what is the intuition here? The intuition is the following. If this ratio on the right-hand side in Formula 11 becomes too small, okay, or sufficiently small, it means that the lender is under the risk that the collateral will not cover, the loan that she actually gave to the borrower. And so to cover that risk and to prevent any non-repayment of the loan, I'm going to liquidate the collateral. What does it mean liquidate? It means the following, and it's a key element of lending activities. It means that when the collateral becomes insufficient to cover this risk, then part of the collateral could be sold by the platform to a new actor of the story, so-called liquidator. I'll tell you in the next slide what a liquidator is. But in order to complete this reasoning, let me tell you, just to go and be concrete, that if you open up the Aave documents, so the official documents are Aave, they describe the liquidation activity using this ratio, health factor, they call it, health factor. It's nothing but a ratio in, Formula 11, where the tau is brought at the numerator on the right-hand side to have an index, which is now the value of the collateral over the value of X, where the value of a collateral is weighted by this number tau. For instance, tau could be 0.8, okay? And the interpretation is the following, and also the application is the following in Aave. Suppose the tau is 0.8. So basically, this ratio, the health factor, becomes a ratio between 80% of the collateral value divided by the loan value, okay? 80% of the collateral value divided by the loan value. If 80% of the collateral value divided by the loan value is larger than 1, then the loan is healthy. There's no danger that it will not be repaid, or etc., because I have enough collateral. But if instead 80% of the collateral value goes below, divided by the value of the loan, goes below 1, okay, goes below 1, then liquidation takes place. And what is liquidation in practice? In practice is the following, in a nutshell, if you want. Anyone interested in becoming a liquidator, so anyone, even you and me, can become a liquidator. And in fact, these liquidators are actually now an industry. They observe in real time how the collateral goes against the loan. And if they observe the collateral is actually reaching the threshold of 1, the L factor is approaching 1, they can participate in an auction with other potentially interested liquidators to liquidate that operation. So suppose you got the auction and you became the liquidator. What do? What you have to do is to pay up to 50% of the loan, okay? So up to a half of X to the principal. So you basically give this much. So suppose X is, the loan is 100 Ethereums, okay? So you can give up to 50 Ethereums to the principal, taking in return part of the collateral, in fact, exactly the same value of the collateral. If the collateral is in another currency, it must be the same value in dollars. So what you give in dollars to the platform by paying 50% of the loan on behalf of the borrower, you get in return from the collateral. You get 50% of the collateral, you get the equivalent of 50% of the loan from the collateral paid in the original currency that was deposited as collateral, plus a bonus. Okay, that's the key point. Because if you repay 100 and you get 100 from the collateral, it doesn't make any sense. It makes a sense to be a liquidator. That's why a whole industry developed. Because on top of being repaid half of the loan, of repaying half of the loan on behalf of the borrower, you receive from the borrower's collateral, you receive a bonus still from the collateral deposited by the borrower. So basically, that's the incentive to become a liquidator. And there's a whole industry there. If you're interested in, you can, navigate into and crawl into the internet to see there is a whole industry for these lending platforms of liquidators participating to liquidate in order to get this bonus. Could be 5%, could be, depends upon the platform, okay? But you must be careful, because as you are waiting to receive part of the collateral and the bonus, prices may change suddenly, and what you were expecting to receive is actually not what you do indeed receive, but maybe much less because of price oscillation. So you have to play that game, and everybody is actually warning unexperienced people to be careful. You have to play that game if you really understand how to do it and you have enough experience. Now, what time is it? Because it's only an hour and a half, but I will still have something to say. Can you tell me how much time I've got to go before
now, like we just have for the planning session, we just have 5 minutes. But
okay.
If the community is willing to follow us for extra 10 minutes if needed, we can do it. Just write in comment, guy.
I'll try to be brief for the part regarding some of my own work. Recently, in 2024, I became interested in AMM, and I wrote a paper which was published in this. This is one of the specialized journals, Frontiers in Blockchain. And the idea was the following. Suppose you have a liquidity pool, okay, like in Uniswap, made of 2 currencies, okay, X and Y, 2 cryptocurrencies. And suppose that the market price is P, which tells you how many units of capital Y you can get with 1 unit of X, capital X, in the market, outside the market, the automated market maker. So the market value expressed in terms of capital Y of the liquidity pool is X times P plus, so small x times P plus Y tells you in terms of capital Y, asset Y, what is the value at the market price of the liquidity pool. Similarly, if you take the same expression, divide everything right-hand side and left-hand side by P, you get the same value, but except that it is expressed in terms of asset X rather than asset. And suppose you take, which is one of those functions that is used in reality, in fact, also by Curve, if I'm correct, an extension of the constant product, rather than having X times Y to determine the price of a trade, you have X to the power A, where A is a positive number times y to the power b, where b is a positive number, which are of course specified by the platform. Could be, you know, a equal to 2, b equal to 3, or whatever. And that should be equal to k. So the question that I posed is the following. You know, we have a monetary value here of the liquidity pool. We have a constant price, a constant product function here. This will determine the price. You know, we have all these variables, okay? And the question that I pose to myself is the following. Is there any link between all these variables, or they can change freely as they wish? And the answer is, if you assume that price arbitrage activity has taken place, the answer is yes, there is a connection, well-specified connection. Under arbitrage, which in practical terms means that the price within the AMM is the same price that you find in the market outside AMM, basically. That's the arbitrage assumption, which means this. On the right-hand side of 13, you can check, you will have the price in the AMM, within the AMM. On the left-hand side is the market price. Arbitrage activity implies that these two prices are the same. If you introduce this equality, so you replace P with A times Y divided by B times X, etc., what you get is something, if you want, in some sense that you expected. Namely, there is a strictly precise relationship between the value of the liquidity pool, the constant product K, the size of X, the size of Y, and the market price. And these are the expressions. In particular, you see K, which is this, and M cannot vary as they wish, cannot freely vary. For each M, there is only one K if there is arbitrage. So basically, value and K are not disconnected, you know, freely disconnected. They have to obey a law imposed by arbitrage activity. They have to stick to a relation imposed by the arbitrage activity. I want to skip this to get to basically the point before the final slide, which is this one. An interesting characterization of what I found here can also be can be given by the following observation. Suppose you want to maximize the product X times Y, which is the function used by Uniswap, assuming, so under the constraint, that this is your wealth, okay? Sorry, this is the value, under the constraint, this is the value of the liquidity pool. So you fix the value of the liquidity pool, which is this, and you want to maximize the product between X and Y, given the value of the liquidity pool. So M is given, okay? And you want to find the maximum K, which is the product. To find that, you have to maximize this function with respect to X and Y. If you do that, I'm going to skip details, you're going to get a solution which, for the particular case of Uniswap, namely A equal to 1 and B equal to 1, in this number 12 constant product function, if A is equal to 1 and B is equal to 1, we got Uniswap. If you assume A equal to 1 and B equal to 1, the solution that you get, you can check, is the solution that you get with arbitrage. So basically, you can characterize the arbitrage imposition on the axis y, k, and m as the solution of this maximization problem. But what is more, because when you maximize, there is so-called dual problem, okay, that can be solved with the same solution. You can also find the same solution by minimizing the value of the liquidity pool such that you fix a certain level of K. You will still find that this is the solution, okay? So that's another way to characterize what I found, namely that what I call the arbitrage equilibrium, which imposes a particular relation between M, the value of the liquidity pool, and K, the level of the constant product. The arbitrage equilibrium can also be seen as the outcome of a maximization of x times y given the value of the liquidity pool, or the minimization of the liquidity pool, or the value of the liquidity pool, given the level of the product. Last, on which I'm working, and so I had just one slide to tease you a bit. And this is the project that is going on with exponential science. I'm doing a research paper on that. And I'm posing the following question. Let's go back to the pillar of the lending activity in automated market making. It is the collateral, okay? The collateral is kept locked, so idle until the L factor goes below 1, in which case it is liquidated, okay? But if it's not liquidated, it stays there and taken back by the borrower once the borrower repays the loan. Now, I'm posing the following question. Modern banks, I go back to the Middle Ages, in particular, the town where I live, Siena, which is a medieval, still very medieval town, was one of the leading cities in the Middle Ages, inventing, together with Florence, Milan, Genoa, and some French cities, modern banking. Venice as well, by the way. Now, modern banking is not like original banking. Original banking in the old times was just for safety. For instance, you were a rich person in the 1200s in Siena. You had a lot of money. You would go to a bank to keep it safe, to prevent the risk of being stolen the money. But the bank would keep it there, would just survey, monitor that nobody will steal it, but it wouldn't lend the money. But since at some point, evidently, those organizations, which were, let's call them bank for simplification, those banks realized that much of this money was withdrawn very rarely, okay? It was staying there idle, nobody was using it, it was just protected. So since it was staying there idle, they said, and nobody was using it, or very rarely used, then they started to think, well, why don't we lend this money, ask for some interest in return, and make business? So basically, rather than keeping them locked, they started to sell. And that's what happens with modern banking. As you know, modern banks don't have all the deposits available, in the bank, because a good portion of it is actually lent. So that's why we want to avoid bank runs, because there wouldn't be enough liquidity to satisfy every request of every depositor if they come all together. But now that's how modern banking works. And the question is, can collateral in DeFi applications like the lending platforms, can collateral be used rather than being locked as much as modern banking is doing? Can collateral be used to, to make more loans rather than being kept locked there? That's the question I'm working on at the moment. I haven't, based on my knowledge, nobody has discussed this question for collateral in DeFi. And I do have an intuition that I have to check, which I write in this last bullet point. It could be profitable to lend part of the collateral as well if the collateral is sufficiently large as compared to the interest rate charged by the platform to the borrower. But I want to stop it here. These are the conclusions, just wrapping up what I just said. Let me just go to the last bullet point where I say that the industry is work in progress. This is, the whole cryptocurrency story is work in progress. And another project that I have at the moment is the following, just for your curiosity. We're heading towards a situation where if you go in a shop and want to buy an espresso coffee, there will be, not very far in the future, shops accepting cryptocurrencies on top of euros or dollars, on top of the legal currency. So there will be multi-coins, multi-currencies to pay with. And this is a world which we don't know very well. No, not very academic contributions are available. And it will develop soon, in my view, okay? So we're gonna face a situation which is going to be quite different from the current one, although the current one is already quite different from the one 10 years ago, okay? So it's work in progress. We don't know exactly how things will go. Very much depends on politics. And I don't need to tell you why, because you know, I'm sure you are up to date with the current international politics. And this is the end. Thanks for your attention, and I hope the presentation generated some interest if you haven't seen this topic before. So thank you very much.
Thank you, Dimitri. Thank you for your incredible session. I hope that everyone here has at least benefit from some of the aspects, and I believe that, like I see in the chat now, there are a lot of excitement from the community and a lot of people thanking you for this session. Actually, if you want,
Yeah, I'm here to answer questions. I'm pleased if you found it interesting. Very pleased. Try to put effort as an academic. I always try to put effort in making myself understood. Question, please.
Yeah, let's start with the Q&A section. Just click on it. You'll find 3 or 4 questions. We can start with them. In the meantime, if there is anyone who's willing to ask a question, please open your mic and the floor is yours.
Yes.
So let me start by the first question in the Q&A section. Shouldn't we consider arbitrage to be natural and beneficial activity to swap pools? It solves the issue of supply and demand by buying cheap tokens in a pool high supply
Well,
conditions and
yes, I agree. I mean, it's a fact. If you are an investor, if I understand the question is arbitrage a natural thing? Yes, it's a natural thing if we assume that the financial markets, whether traditional finance or DeFi, are populated by investors and people wanting to make money out of. Yes, if there are people wanting to make money, one of the ways to make money is to arbitrage, okay? Namely, to exploit the price differentials of the same objects in different markets. But if you do that, of course, you shift demand and supply from one market to the other market in such a way that eventually the two prices, the one market price and the other market price, will be similar. And when this is reached, there's no more arbitrage to take advantage of. But that's a kind of equilibrium, okay? Because just because you can't do, the buying and selling to exploit the price differentials, that will actually stay. So in some sense, it's a natural phenomena. And it's, again, let me use another word, which is probably even stronger than natural, is unavoidable if the markets, traditional and DeFi markets, are populated by, expert investors who know how to move the money and how to take opportunities for making profit margins. So, of course, there's never perfect arbitrage, never perfect equality of prices, okay? Because you have waiting times to transfer one, to buy one money from the others. That's why automated market makers actually, to some extent, may favor arbitrage because it's instantaneous trade. Trade is instantaneous. You don't have to wait, as I said, like in centralized markets, okay? So it's encouraging arbitrage activity. So if the market is populated with people who know how to make money, arbitrage will take place. So it's natural and also unavoidable at the same time. But of course, there will be small time intervals where arbitrage doesn't hold, but then people would arbitrage again and prices would tend to converge once more, okay? And of course, you may say, oh, but I'm noticing that these two exchange nodes like Binance and Kraken, they are having slightly different prices for the same two objects. And they keep being the same, and this difference keep lasting forever. Why is this so? There is no arbitrage. If you see a difference lasting forever, is because exchange fees are different, okay? And so taking account of exchange fees, maybe one of the platform is more expensive than the other in to trade currencies, then you are observing arbitrage, which, however, is also taking into account frictions given by trading fees, or perhaps you have also to pay for gas if you're using Ethereum as an underlying structure, okay? So there may be some additional expenses which could be different between different platforms that could keep some differential between the prices. That doesn't mean that there is no arbitrage. It means that the arbitrage advantage has been completely exploited, but the price don't coincide because trading fees are different. I hope I answered something at least of your question.
yes, I guess so. So I think we have Mohammed. If you want to open your mic, please go ahead.
Go ahead, Mohammed.
Okay, thank you, sir. My question is, what strategies can users apply to avoid large slippage losses when trading in low liquidity automated market pools?
I'm not sure I completely understand because my maybe can you write quickly your question? I'm sorry about that.
Okay, my question is, I said that what strategies can users apply to avoid large slippage losses when trading in low liquidity?
Okay. Now, if you look, sorry, tell me if I understood your question. What kind of strategies we can apply to avoid a large price slippage or something like that?
Losses when trading in low liquidity pools.
I'm not sure I heard.
Same
Slippage
for me here.
Is it possible to write in 2 lines quite quickly your question?
Okay, sir. Let me write.
By the way, I take this opportunity to ask you, where are you located in Africa? Everywhere?
I'm in Nigeria.
Okay. What about the rest? Anywhere?
I dropped my questions in the comments.
Tunisia.
Let me see.
Actually, what strategies? Yeah, I can see it now. What strategies can users apply to avoid large slippage losses when trading in low liquidity AMM pools?
Oh, that's a very good, very interesting question. When there is low liquidity, what kind of strategies we can use to avoid large price slippage? Am I correct?
Yes, sir.
Well, the first strategy is not to trade. Okay. Or from the platform point of view, if you notice that a liquidity pool is getting short of liquidity, and if price slippage is something that could damage your platform because people would not want to trade in if the price slippage is becoming, too much, etc., too volatile, then you as a platform, you can actually inject liquidity in those pools where there isn't enough liquidity. That's my, first reaction. I'm sure there could be other strategies, but as a very first reaction from the side of the trader, well, the trader is probably less interested in a large price slippage, but the platform would be perhaps very interested in, mitigating price slippage. So suppose you are a trader who cares about price slippage. If there is low liquidity, you don't trade. Okay? You just wait because it's perhaps something that you don't want, a large price slippage. You have no ways to control. You don't trade. You hold on. From the point of view of the platform, you inject liquidity. That's a very, super simple answer. I agree. But you cannot force depositors to deposit additional liquidity. So the only, I would say, strategy that you can control is your liquidity. Or perhaps, in order to give an incentive for more deposits, you can raise the reward for depositors. But that's not that will not have an immediate reaction because people would observe that the interest rate has increased, will make comparisons with other liquidity pools. Is it convenient and now that the reward rate has increased to deposit in this liquidity pool? Yes or no? It would take some time perhaps to attract depositors if you raise the reward rate for depositors. So if there is an urgency, you can't wait, just inject liquidity, hoping that you have some liquidity yourself. If you can wait, raise the interest, the reward rate. Of course, that will increase your costs, but that's, I suppose, one of the few ways you can actually use to attract new depositors and to increase liquidity in your pool. That's my first reaction. I shall have to think more about it.
Thank you very much, Professor Dimitri, for your clear explanation.
Thank you. Thank you.
So in the meantime, people are mentioning in the chat, we have some of from Tunisia, Cameroon, Nigeria, Cameroon, Nigeria as well. So we have North Africa, West Africa, Kenya as well. So it's kind of from all over the continent we are, let's
Beautiful,
say.
beautiful. I would like to take a flight and come to visit all of you, but I can't.
I hope we can do it soon, since we have like the Hackathon station on 20 over 20 Hackathon station in different countries in Africa.
Yeah.
And stay tuned, guys. So we will share the entire update in the next couple of weeks.
Okay. Okay. So it's a great initiative. I really liked it. So that's why I said yes when they invited me to. Okay. If there are no more questions, perhaps we could stop it here. But if you have, later on you think, well, I wanted to ask this particular question to Professor Dimitri, don't be shy and send me an email. Okay, my email is available at Exponential Science, but it's also available on my website. It's very simple. I write it here, perhaps. No, where is it? I can't write.
I will share it for you, Mr. Dimitri.
Yeah.
So it facilitates. Also, I would like to mention, guys, if you want to, like, we have the Discord channel there, like all the community is gathered, and you can like, we can collect all the questions that we have and send it to you in one pack. And I guess it's gonna be
good,
much.
but yeah. Let me admit, I'm not very much a social network type of person. So I'm not accustomed to, to spend a lot of time on social networks. But if you can send me the block of questions, I'll do my best to answer everybody.
Also, there are some participants asking for the presentation. If we can share it with them.
I can send the presentation to Salman.
Yeah, good. And from that, we will share it on the community channel for the hackathon.
Yeah, absolutely. And please don't be shy. Send me your questions in case you are interested in receiving a feedback. Okay? Hello?
Yeah, sure. We will share all the data. Please thank you again, Mr. Dimitri. I hope this session was fruitful for everyone. I think it's time to close. Yeah, go ahead.
I hope you don't feel you wasted your time. Okay, so that's my goal. Okay, thank you very much again for your patience, and I hope to be in touch again for other reasons, etc., etc. Okay.
Thank you, sir.
Bye-bye.
Thank you, and
Bye-bye.
bye-bye.
Thank you, sir.
Good evening.
Bye-bye.